Welcome back, everybody. I hope that was good for you. Some more thumbs ups. I see a couple. Yes, thank you. All right, we will get started. Looks like I am right on time, 7:25, to start talking about our sponsors. We just wrapped up the networking, and I want to remind you now that we're done with all the networking, if you go to down below where you can see the chat, and in chat, you'll see you put in your information, your name, your company, your phone number, your email, and your location. And this is your virtual business card at the end of the evening. And this time I put little at the top right of the chat, you'll see these little three dots. This is at the top right, and you click on that and you can hit save chat. It saves a text file to your hard drive so that you can have all of the information from the people that you met tonight. Hopefully you made some new friends and some new business acquaintances. So that's what this networking is all about. You know, we don't get to do this as much these days because we do it in Zoom. Hopefully this suffices. And I know it's not quite as good as being able to actually see somebody and shake hands, but you know, it's the next best thing. So next, we want to say in memory of Gene Carino. Gene was instrumental in the founding of the REL Academy, REL National Association, and introduced thousands of people to the model of the residential style assisted living. His motto was, do good and do well. We do miss him. I encourage everybody to visit our website. We try to keep a lot of information on there. There's certainly recordings over on the event side. You can access all of our recordings from all of our meetings that we've had since I started doing this. This is actually our 98th meeting. I didn't start doing the recordings until 2000 when we had COVID come in. So, you know, we only got about maybe half of them there. If you are in Colorado, you may want to click on the helpful links because in here, the very first links in here is the chapter 7 and chapter 2. These are the state regulations in Colorado. And these are things that you need to know like the back of your hand if you are operating in Colorado. If you're outside of Colorado, you might find some information on here that's helpful for you as well. Just these two links probably won't pertain to you. And I encourage everybody to join our Facebook. And let me drop this link into the chat. So if you want to join, you can just jump in there and let me see here. Sorry about this. I gotta figure out how to get everyone on this. Well, I'll come back to that. I'll make sure I get that dropped in. And moving on. And thanks to everybody for signing up on our meetup. We actually hit 1,200 members today, so I need to update this slide. But that's a big number. Hey, we're getting somewhere. We're somebody now. And next, I want to get into our sponsors and thank everybody that helps make this happen. You certainly saw the pages to start with. We will start with Hall Ryan Construction. With 35 years of combined construction experience, the exceptional team at Hall Ryan Construction has transformed residential properties by bringing high-touch, customer-centric approach to every engagement. On the insurance side, Hall Ryan's reconstruction and roofing expertise is a skill that many insurance companies actively seek out. Their reliance on Hall Ryan's experience in helping them write estimates has made Hall Ryan a well-respected, trusted expert in the field. And you can reach them at hallryanconstruction.com. And next we have Assisted Living Mansion. Brett Jacquet has put together a really nice program for a high-end 16-bed model. Also on his website is a great collection of training videos, mostly geared to the experienced operators. So you can navigate to palm.university and get more information. And then we have the RAL National Association. That is at www.ralnag.com. This is a national association for the smaller facilities. If you have something smaller than 20 beds, I suggest that you join them. It's free, and you get lots of information. There's some group buying power on there. So make sure you check out their website, ralna.com. We do have a link on our website to the RAL Academy. If you're brand new in this assisted living space and want to learn about it, then I recommend you go through their course. It's basically basic training for running an assisted living. So ralacademy.com. Then we have our website, Guru Assisted Living Marketing, and Peter is actually here with us tonight. I'll let Peter talk about his business.
Thanks, Vern. Good to see you. Good to see everybody. Yeah, we've been working with residential assisted living for just a little over 15 years at this point, and started here in Colorado and work with companies pretty much coast to coast at this point. And so anything from websites, logo and branding design, do some print media as well. All focused on, how do we get good quality leads uh, to reach out to you so that you can improve the census in your community. So lots changing with around AI and content and website search and ranking. So we've been working hard to get things dialed in for our clients. And if you want to talk about any of that, we'd love to have a conversation with you. Thank you.
Thank you, Peter. Peter's also going to present for us this year on AI and your website and your marketing. So that should be a very interesting presentation. Stay tuned for that one. Next, we want to talk about senior care administrator coaching. This is Janet Cornell, and Janet provides consulting for your assisted living home. She can also provide the 40-hour administrative training. This is here in Colorado, staff training, and employee file compliance and compliant documents. Janet also does mock surveys, so she can go through your home, tell you what's wrong with it before the state does. And if the state goes through and finds something wrong, they charge you for every infraction. So Janet can save you money that way. Even though you're going to pay her to go through, it's going to save you a lot of money. So you can reach her at scac-janet.com. Next, a group that I've been part of for many, many years, Investment Community of the Rockies, ICOR, is Colorado's only nationally recognized and award-winning real estate investors association, serving Denver Metro, Colorado Springs, Fort Collins, and Northern Colorado, as well as real estate and rental property investors across the state. So you can reach them at icorockies.com. And our friends at Pinkowski Law, Michelle and Brian, they're not only Colorado's assisted living lawyers, but they do some work nationwide helping people combat the HOAs and zoning problems that you sometimes run across. They help developers and operators of assisted living and group homes locate and establish their facilities so they can focus on the business of caring for people. They will act as your advocate or work with your local council to encourage compliance with the Fair Housing Act provisions. That's pinkowskilaw.com. And then we've got a Better Way Funding. This is a group that I'm with. We do the lease options for assisted livings and group homes. We're like a bridge before you get into the SBA. You use the SBA to take us out. So it's just another way to get through that. And I do have a link in there under my name, ralleaseoptions.com. And we also have ABW Capital, Capital Ventures, and we've got three investments that are available right now we're working on. There's the Las Vegas which is Avenir. It's a trophy hold. It's our newest building of the three, triple net lease structure with solid demographics. We're going to pay a little bit more for this property, but it's durable, low touch cash flow. And we have one here in Colorado called Gordon Orchard. It's in Greenwood Village. We call it a coupon clipper because it's the lowest equity. The tenant covers everything as a triple net lease, and the option caps the upside and locks the IRR on that. And then we also have in Georgia one. This is Marshall Pines, and we call this a deep value swing because on this one we will actually handle the management, the ownership of the business as well. This is our first one that we will have that business under our management. It's the cheapest basis. We're getting a really good deal on it. It's got the highest IRR, and we've got a very good management company to come in and run it for us. So if you have interest in investing, on two of the three, you need to be accredited. On the Greenwood Village, we are taking some non-accredited investors. And there's my contact info at the bottom. And it's also in the chat. And speaking of my business, I am a sponsor, so I have to talk a little bit about it. Grand Avenue Business Brokers, I've got over 30 years of business experience, over 80 assisted living transactions, over 100 million from those. I am a certified business intermediary and a certified senior housing investment professional level 2. That's something new that Nick came out with. And of course, my specialty is assisted living. So you have my contact info again. And we have been a little bit busy. Oh, I want to talk about this deal that we have for sale. It's in Eastern Colorado. It's a package of 4 facilities, plus there's some land that goes with it, and a duplex and a little single family home that you can put staff in. It's thrown off after you have management in there to run it for you. It throws off 900K, which is a 15 cap on a $6 million purchase. And we've actually had Mackey with SBA take a look at this and give us a $5 million-ish number that they can loan on it if you're a qualified borrower. So for information on that, you can reach out to me. And we are really busy right now. I've got under contract a slew of deals. So if you need help buying or selling, then go ahead and give me a call. And with all that said, I don't know if we have anybody from the Colorado Assisted Living Association here to speak. So I do know that they have done some legislation work recently. Most significant is they got through a bill and got it passed and signed by the governor that if you are 19 beds or under and looking to increase your bed count without doing any changes to your facility, it used to be that you had to go through FGI approval. And that takes about 6 months, and it's a real pain in the butt. Well, now, if you're not doing any changes, you can do an additional beds to your facility without having to go through that FGI process. So yay for CALA, they did a great job, and they really helped the industry. Okay, I think that's about it. And man, look at that, 7:39. I am just about on time to introduce to you Mackey Hughes. I met Mackey several years ago, and we have stayed in contact. He's presented here a few years ago for us. I ran into him at the NIC conference this year and thought, I ought to ask him back and chat because he knows a lot about this SBA. Live Oak is probably the biggest SBA lender in the nation. I refer all my clients that are looking for SBA to Live Oak. And thank you, Mackey, for joining us. If you want to take the wheel.
Sure. I'm gonna see if I can share my screen real quick. And do screen. All right. Does everyone see that all right? Good to go, Vern?
I can see it.
Perfect. Okay. All right. Yeah. So yeah, my name is Mackey Hughes. I've met quite a few of you, and glad to be in front of the folks that I have not met yet. As Vernon said, we've been doing this for a considerable amount of time, focusing on the owner operator segment of senior housing. We also do home care, home health care, hospice. But my main focus and my background's always been on the facility-based side. Approaching 10 years here at Live Oak. Prior to that, I was with M&T Bank and doing more of the big box stuff, the HUD stuff, multifamily. Started there as general counsel for them, and then started doing loans with them as I progressed through the industry. This is a huge portion of what we do on a vertical basis at the bank. We've got a group of about now 8 lenders that solely focus on this nationwide. And we've had our largest year to date. And so we're excited to continue that momentum. Obviously, over the years, been doing the presentations at Rala. I'm sure some of you all have seen this a couple weeks back. Some of y'all were in some of their webinars and kind of get-togethers online. These are all very valuable. I know they're a little bit later in the day, so I do appreciate the time. Right now, capital markets in senior housing have been a little bit stagnant on leverage, which means how much money banks or REITs or anybody is going to lend to the space. Right now, if you're looking at a conventional deal, bridge to HUD or something to that effect, you're really looking at 60% leverage, which is not attractive. And so what is attractive has become the SBA side, right? Anything kind of sub 7 million, we'll look at it one way, and then you can kind of go up to 15, 17 million in another way, depending on the product you go with. Average deal size for this stuff is over the past year or so has probably been around between 2 to 4 million, depending on which state you're in, how many beds you have, and all that. We lend in all facets of it, right? Startup, acquisition, expansion, working capital, rent replacement. It's all able to be done in some way, form, or fashion with the SBA. It's a great product for leverage, a great product for the owner operator, and I don't see that changing. I will say this, that the new SOP, sort of the rules of SBA, they update those, from time to time. The new administration has made some changes or suggested some changes with their appointees. And so all of those changes are going to be officially published beginning of next week. So we've got a pretty good, as Vernon said, a pretty good network with SBA being one of the larger SBA lenders, if not the largest by volume in the country. So we have, our folks in DC, lobbyists. We have a good idea of where these rules are going to shake out, but you never know until they actually, put them out last minute. So, most of the stuff that they're making changes to is not going to be anything crazy. But just wanted you all to know that, if you might see a little bit of a difference in, requirements for a down payment, but minimal really, from what we can tell, speaking to our folks on the Hill. So I'll get started here. Again, we're focusing on the owner operator. It doesn't mean we're not doing bridge to HUD. It doesn't mean we're not doing the sort of the conventional deals, but 90% of what we do is right here, with folks like you all. And that's where we shine. But if you see stuff out there for larger deals, we do those here and there. But this is our bread and butter. So stated injury, I always put this up here. It's not really changed much, unfortunately, in the last 5 or 6 years. It's gotten a little bit easier post-COVID with staffing, but that's why everyone's sitting here, spending their evening. Smaller facility model and the demand, right? That's where we see a huge growth, as all of you know. We're excited. our credit folks are excited. And we've done quite a few of them throughout the country, and the portfolio has done extremely well, compared to other industries. And obviously that's just, the demand, the silver tsunami, all the things, and just the growing population and population centers, throughout the country, adult children moving to, places like Denver, people moving sort of from the Midwest to other places, to follow that, driven by jobs, driven by lifestyle, remote working, whatnot. But at some point, people, will get to a state of acuity where they're gonna need facility-based care, and this model provides that. It's a boutique model, and most of what this is going to be private pay, right? The larger stuff, we'll look at Medicare, Medicaid, depending on whether it's skilled nursing or the lower acuity assisted living. But that's sort of our, our safety net, right? We can control expenses by controlling revenue and all that, and that's how we'll underwrite it. Construction is a huge component right now, of what we do. We are one of the largest construction lenders in the whole country, not just in, residential assisted living, but throughout, vet, dental, self-storage, you name it. We do all of that. But we verticalize our group. So we don't want credit boxes to change. We want to stay with this industry and our group and let our colleagues be experts in those other industries. But if you have those opportunities, we can point you in the right direction. Staffing challenges, not as bad as it used to be. People don't have, all the sort of the government assistance and other things that COVID, kind of provided to the market. So that's a great thing. For our borrowers, and for the industry in general, that we're getting good caregiver, retention, is what we say, to kind of keep things rolling. So those are kind of the main themes there. But that's a big one, and that's normalized over the past couple of years, which has been a nice thing to see. So when I think owner operator, I think our credit box, and I think what we really shine at is SBA. 7A is our bread and butter, but I do quite a bit of 504. Honestly, that's becoming more prevalent. There is cash out refi available to a higher degree than it has been before. So 504 has been something that people have used to kind of get where they need to be as far as expansion. But mainly, 7A has been the best. If you see on the left side of that, everything can be financed, right? Your working capital, your intangibles, all those things are important when you're starting, expanding, hey, I want to hire some more people. You can kind of throw all that into one loan. It's not a construction to perm. We would do a construction, and everything in that loan, and they go out to 25 years, really 26 years if you are doing a startup construction deal. 504, do larger deals, but you're really only lending against the tangible asset, which means you're only lending against the real estate. So we'd have to get a little bit more creative there to kind of help with the FF&E, working capital, stuff like that. 7A does also allow you just to buy the business. You don't have to buy the real estate if you're looking to purchase just the business, and later on maybe take down the real estate after you have a year or two of historical financial performance. USDA, we do a ton of that, but we're more in the solar farm world. USDA takes quite a bit of time. If you own the land, maybe you get a little bit longer of a term. But really it's been people wanting to go fast. And that's where we win on the 7A and the 504. But mainly the 7A, we're a preferred lender. So it'd just be like doing a regular bank loan as far as timeline goes. A lot of people have these conceptions that SBA takes a while. In some cases that's true on the 504, but if you're with a preferred lender on the 7A, it's really not something that is going to be any slower than a regular commercial loan. And then just kind of a little bit more on this slide. It's interesting, a little bit more here on sort of how we sort of figure this out. I did make some adjustments with the new rules coming in. 10% is going to be the minimum. If you're doing an acquisition, you're not doing an expansion. Even if you're doing a startup, 10% minimum, maybe a little bit more, depending on how your deal pencils out, what you're charging, how many beds you have, or whatnot. And then rate, we have some options there: floating rate, fixed rate. The prepays are always better on the 7A. It's only 3 years. That starts day of close. That's important to think about, because you're probably going to be building this thing for a year. It's going to take you a year to fill it up, and really a year of like solid, performance at a higher occupancy, to where you're more attractive, for a lender, even us, to refinance you, or you go to the next step. Important to note, this is all for profit, right? We're not doing nonprofit. We're not doing subscription model. We're not doing the CCRC stuff. This is all for profit, and we'll go anywhere in the country. We've done quite a bit in Alaska over the past couple of years, Puerto Rico, Hawaii. We're not limited at Live Oak Bank to stay in any sort of market or sub-market. And then the other kicker for us to sell is, we're not afraid of tertiary markets, aka rural markets. There's a product for every market, and we just want to be involved in it. So how do you get a loan? What do we think about? What are your, I get all these questions like, how am I going to qualify, do all this? Can I get a pre-qual? Can I do all these things? And you'll see this with other lenders, good lenders. They call this the 5 C's of credit. I'm sure you all seen this if you've seen any of our presentations, whether it's me or my colleagues. You got to feel good about character, I think, is the most important, right? Cash flow, good credit score, post-injection liquidity, which is capital enough to where we're not cleaning you out on the down payment. And we're obviously in this going to have collateral already, right? With the care home, but character is really where we hang our hat on, right? We go see every single deal we do. This is an operational minded underwrite, right? This is a business that just so happens to have real estate in our minds. We're taking care of people. You're taking care of someone's loved one. This is not more of a passive real estate investment, like, again, self-storage would be, you would think, or flipping houses, whatever it is. We really underwrite to that business plan. We really want to make sure we're putting the right people in the right place to take care of other people. I know that sounds kind of cheesy sometimes, but you mess up, you only get to mess up once in this business, and then you're done. So it's really important that we're in with the right partner, taking the right risk, and making these things the best places they can be for the residents. I mean, that's got to be number one for everybody. Leverage, huge question. Everyone asks about leverage. First thing they do, even above rate these days, is leverage. And the reason being, like I noted earlier, is there's really not good leverage in capital markets out there right now for really much anything, especially senior housing, right? Senior housing for lenders is when you underwrite it, is operational, no matter if you're the big dogs or you're the little guy. There's risk involved with it. And so there's licensure, there's inspections, there are all the things that go in with that. So when you think about what we can offer as far as leverage goes, it's pretty attractive, what SBA allows us to do, assuming cash flow is good, assuming we have good guarantors, and the right folks with good character. Startups, I generally do see it kind of lands at 15%. If we can go to 10, we will. If it's 20, it's 20. It's really going to depend on what your pro forma, your projections are going to show, what we feel comfortable as a lender doing. But I just think it all kind of pencils out around that. And then sort of your construction costs and what you're building, and the risk that's involved there. So we will do the best we can to have a larger loan, right? Everyone likes to do a little bit more there, but we're not going to put you or the business in a bad a bad spot, right? And 5% is meaningful, right? I get it. But we're going to do the right thing. We're going to be prudent lenders. If we can help you to stretch that, we will. But knowing now it's going to be minimum 10, likely 15%, when you're at the end of the day with your final bids and whatnot. Look, the other thing is the expansion side of it. Once you have your, your first one or two and they're really doing well, we can do 100% financing. That is not a problem. We do that all the time. That's a big sell point. Once you're up and running, that's kind of where you want to be, after your first one, got a good year worth of performance. We'd be happy to do the next one without any cash out of your pocket. And so we've done it plenty of times. Now, when I say that, if you've got, a 12 bed, a 16 bed, or 6 bed, you're not going to get 100% financing if you're trying to do a 50 bed, right? I mean, it's going to be kind of the same sort of product to get to that point, to get that higher leverage. But that's sort of that little carrot that we have for folks, that work hard to get that first one done, and then make the next couple a lot easier on the wallet. Oh yeah, another thing. Again, remote ownership, passive investing, we can't have that. We can't have that look like that. We have people that do have facilities that are maybe not in their market, but they've been proven to show they can do that, or they're you believe they can get an apartment, or have that first year they can get out there and do it. But the business plan and being reasonable about that ask is really something that our credit folks are going to dig in on. Starting a business out of in a new market, where maybe you don't know many people, maybe you don't know your referral channels, that makes it a lot tougher to get approved, and just kind of being reasonable with that ask, right? If you're proven to be able to do that and you put the right people in the right place, great. But just keep that in mind, as you kind of progress through your business plans and look at new opportunities, and then you go to lenders like us. Yeah, so a little bit of a differentiator, kind of noted earlier on one of these slides. We're going to go a little bit higher in debt, over sort of the parameters of what other SBA lenders will do. A lot of them will cut you off at 5 million. We'll go over that, to a degree, to get a deal done that makes sense. And so that kind of gets you to that 7 to 10 million that we could do in house. And I hope everyone gets there, because we'd love to do those deals. But just kind of think about the program, right? You'll have lenders that'll kind of sell you outside of a 7A to do a 504. You're going to bring more money in. We love to do a 504. Every bank would. It's less risky to the bank, but it's going to be more out of your pocket. It's going to take longer. But I like this slide a lot, because it kind of shows, hey, this is how Live Oak is going to be a little bit different as you scale later on. If you're starting out, or if you're an existing owner, we can really be competitive and get things done for you. We're very bullish on the sector right now, and we've been able to do some creative things over the years. That's really been a great competitive advantage for us here at Live Oak Bank. Eligibility, right? Again, I keep harping on it, but you got to be in that business. You got to be making those decisions. You got to, own it. We call it having the eye of the tiger. We want to feel that. We want our credit folks to feel that. We're going to make sure that's part of the DNA here on doing these deals. Recourse, another thing, right? Everyone love to have no recourse. You get to the point where maybe you can refinance your deal with a HUD loan or Fannie or Freddie loan, where you get 30 years, no recourse, all this kind of fun stuff. It's a little bit here and there with that ending in the care home world. Effectively, we're doing owner operator loans. SBA requires personal recourse on anyone that owns 20% or more in the operating business and the entities involved with that, right? So, that's their rule. You can always refinance out of that later on after you kind of prove yourself, maybe into a burn down recourse situation or not. But That's sort of just always going to be the norm with the small business loan. They're never going to change it. But you know, it's important. I think it's a great part of the program, creditworthiness, right? Because it is, you know, you're putting yourself out there as the owner operator, and taking those structures and making it your own and making us feel good about it. Even though, you know, we have no control on the rules, it just helps us get to those leverage points that, you know, if you didn't want recourse, you'd be coming in with 40%. Here you're coming in with 10%. So that's sort of how it works. Good credit, you know, I always, you know, we've got sort of a little bit of a flexible box there on some of the credit scores. I always say 650 is our minimum, but look, some people go through some things. Maybe if they have a good explanation and we get them going in the right direction, we can be flexible. But you know, you kind of want to have somebody that can manage their own personal expenses and liabilities, to be able to feel good about lending to them. You know, Live Oak is probably one of the more strict lenders on sort of the bankruptcy thing. You know, it has to be a really good reason why we would do a deal with someone with history of bankruptcy. That's just been a credit box that Live Oak's always had, you know, in their wheelhouse. But if it's, again, a good explanation, tough times, maybe it was, you know, the Great Recession, you know, we could get around some of that stuff. But just know that if that's something that's going to be an issue, bring it up to me, one of my lenders on the front end, and we can get in front of it, and see what we can do. U.S. citizen, super important right now. You know, the new administration's come in, you know, clamp down on some of this stuff. You know, if you got your green card, it's not expired, or you're not on extension, you're still eligible for SBA financing. That'll finalize on the 1st, which is, so it'll be the 2nd, so that'll be next week. I've had a couple deals fall out in the past month where they've adjusted those rules, and even if you have your green card on extension, they're not letting those deals close. And so you could be fine, but they hadn't made that final call yet. And so we've had a couple fall out there, but as long as you got a good non-expired, non-extension green card, you're still eligible for SBA. And then, you know, the small business sort of eligibility is like, hey, look, if you've got $10 million cash on your personal balance sheet and you're asking for a $3 million deal, they're going to call that non-eligible likely. That's still going to be finalized on Monday. We don't know that yet. But if you have liabilities, like say you have other projects where that, you know, you might need that money to put on the business balance sheet, that gives you a reason to do an SBA deal. But those are things that they're kind of, you know, honing in on. That last one, there's no cash out on 7A loans, but there is cash out to 85% on the 504 loans. So that's been an interesting and a great change for 504. But don't see a ton of it, honestly, in this sector, but it's becoming more prevalent as people kind of discover that you can do it. Cash out's been a little bit more clamped down with bridge to HUD lenders and other lenders in the senior housing market. So it's nice that SBA took a step out for that 504 program to be able to do that if it made sense for the lenders. All right, so I know I'm running through all this. I'm running through it quick because I know the question and answer section is the most fun and probably the most productive in these types of things. So, all right, what do we need to get a term sheet? You know, look, we can underwrite a term sheet or just kind of figure out high level where we would be, give you an idea what rate would be, product would be. You don't need final bids, you don't need all that, but you want to get as close as you can, right? And that's always that chicken or egg thing that we deal with, especially on the construction stuff. You know, hey, look, I gave you this term sheet based on a price per square foot, and we get bids in later in the day and that thing doesn't pencil out. You got to come in with more, right? So the later on, or the more dialed in we can get with those numbers, you know, the better we're gonna feel about, you know, what we can actually do. But, you know, we work through everything. We do all our construction in-house. We manage all our construction in-house. We manage all our servicing in-house, all of our underwritings in-house, credit approval. And so we can adjust, we can go for a bigger loan. I tend to go conservative on the front end. Hey, let's go get approved or get terms out for something that's probably going to be more than you need, because we don't have to ever go back for a decrease. They don't make us go get approved for a decrease. So I try to do that as best we can, and it works out. But you know, that's what we need. We got to get a good scope so we can underwrite, make sure the projections make sense, make sure your profit margins make sense, your noms are good, all the things you know, we're going to look at as we underwrite. And again, we're underwriting these things, you know, as a commercial loan. So it's not, we don't take it lightly. You know, we are going to dial in on those numbers. We're going to look at our portfolio. We're going to look at folks that are in your market, you know, making sure, hey, you know, does this make sense? We'll secret shop, we'll call other folks. You know, what's cool about this and what's not cool about this smaller model is you can go really boutique. You can go really high end, or you can go middle market. But you know, we have to feel good about what that product's going to be. Proven operators, we're going to give them more credence because they've proven that they can charge their bed rates. They can do what they can do. They can serve a fancy meal and still make money. But you know, we're very vigilant on all those things, and we have a great portfolio to look at to show how you can be successful and show that to our credit folks. So that's sort of the construction side, construction, startup, all that stuff, more risk. We're going to have to do more work. That's more legwork, and that's fine. We're not worried about that. Acquisition, pretty simple. We're going to look at, all right, what'd the seller do? If the seller couldn't do it, they want to, you know, charge a higher price. Fine. You know, are we going to finance that? Maybe, maybe not. Maybe you're going to come in with more if you want to get a deal done. Maybe we're going to, you know, not lever it as much. But we can give credence to a turnaround. We can lend to a turnaround, but we want to make sure we're not overpaying or over levering the transaction. And so we put a lot of thought into the historical financials and what the seller has done. What are they showing as profit, right? Maybe they're running all their personal expenses through. We can go through and do all the ABACs and do the work. But again, you know, if a seller wants to command a high price, you know, the easiest thing for us to prove is showing that high net operating income, showing that, you know, they really are putting forth a business that you can walk into, feel good about, and be successful. And then again, each owner 20% or more is going to guarantee. So we're going to look at your personal side, right? Everybody that has 20% or more, we're looking at personal financial statements. We're looking at any other businesses that they own. How are they operating those businesses? What's the debt on those businesses? You know, have there been issues? You know, how have they managed that? Have they gone through headwinds and they've come out on top? We look at all that, you know, and we look at it from a global perspective, not just the seller, not just the project, but also the people and their experience. You know, and not just senior housing. You could be new to senior housing, but you know, maybe you're not new to business, and how you've done that. We can hang our hat on success. We can hang our hat on resume. You know, a really good idea, someone that's excited, someone that's thought about everything. You know, those things matter, right? It's not just numbers, it's character. So again, you know, just a little bit more simple on the startup. We used to require market analysis. We kind of still do. We can get that in the form of a commercial real estate appraisal. Used to require feasibility studies. Feasibility studies are always great, especially if you're going into a new market, you're building next to other facilities, even big boxes, making sure you're good. Most of them come back favorable. Some of them don't. Very rare that they don't come back favorable right now, but sometimes they do, and we're not going to put yourself in a position to fail. So, you know, feasibility study, market analysis, you know, it's $4 to $5 grand. You're going to save, you know, it's better to lose $4 or $5 grand than lose $3 million. So, you know, We think about those. We're very tactful with those, and it's always good to do that. And that's also something we want to see in your business plans. Timing, another huge thing. 7A, this is your timing for 7A. These are most of the deals we do. 90 days, usually a week and a half to 2 weeks in underwriting. 2 weeks to get approved, or 2 days after that to get approved, and then we go into closing. 5 to 7 weeks into closing. We can shorten that up if we get appraisals. It's important to notice this, right? It's 90 days close, and you have residential sellers. That can create a problem. It's one of the biggest hurdles and biggest barriers to entry in this business. I think you all are aware of that. That kind of leaves you with a few options. As Vern mentioned earlier on this call, he's got something that can help get the thing off the market, and then we can take it out. Those things are important though. If you don't want to go out and get a 30-year residential loan, we can't take that out. We want to be in first. We have to be under 25 years. So a short-term debt sort of piece is what you're going to need to make sure you're safe for an SBA loan to take it out. We do it all the time. And I'm glad Vern's there helping with that side of things, because it is a big barrier to entry for most folks in this segment of the market. And then interest rate, everyone asks about interest rate. There's a big range with it. And these are the reasons for that big range, right? How good is your personal credit? How much are we lending? Are we really pushing leverage? Is cash flow good? Do we feel good about you as a person? The bank's going to they're going to set that rate based on the risk and what the market's going to entail. So we price over Wall Street Journal Prime. We can price over SOFR. We can price over any of these indexes, but generally Wall Street Journal Prime is the norm for SBA loans. We're anywhere between Prime 1, even Prime sub 1, all the way up to Prime 2.25. You'll see other banks that are pricing these things at Prime 275. They actually up the spreads that you can do them. So I always kind of think right now anywhere between 8 and 10% is really where you're going to be. And these are the factors. It's going to be, everyone's not going to get the same interest rate, but we're going to try to do the best we can. Leverage is more important than interest rate right now. Because you're getting, people are paying way above 10 for bridge loans and all this kind of stuff. But we can be flexible. We just have to have the reason to be that flexible. So again, this is sort of the live oak thing. We've got a whole group. That's all we do is owner operator assisted living. Really high end, high up on the mark of volume on doing these, and a lot of stuff we do in-house. And then, kind of that last slide, less of a down payment kind of fits this. There's no balloon payment. We can do everything in one loan. 7A, we can do all the working capital, everything in one loan, put it on 25 years. Pretty attractive stuff. Obviously leverage is why we're so busy right now. And so we'd always love to kind of look through any opportunity you all have to see if we can earn your business. I'd really suggest everyone come straight through my email, straight through either one of my colleagues' emails. We have millions of people going through our Live Oak Bank website, and some of the deals don't get placed in a timely fashion just because of the volume. So please make sure you take note of my my contact information. We've got a great team to work with you to keep things moving quickly, give you quick answers, and sort of sidestep the main droves of folks coming through Live Oak Bank's website, because we are very busy throughout the whole bank on the production side. So we want to make sure we give you all the white glove treatment, right? Because you're taking the time to listen to me ramble on about SBA loans in a weekday evening. So I appreciate that. Right now, I think Vern, if you want to have any comments right now, I'm happy to answer any questions. I'm sure there hopefully will be some questions, and we'll rock it from there.
Does anybody have some questions? All right, Jason.
Hey, thanks, Mackey. Nice presentation. So as far as working capital, do we need to obviously if we're just getting a soft quote, and I'll speak maybe just to you and I are communicating on something right now, last couple of weeks, right? if we've got some working capital and some value add CapEx that we need to roll up into that, is that something we need to be alerting you on the front end, obviously to the full stack, to be able to get that full leverage on that?
Right. So there are a couple ways to do it, right? So you might, you might still be working through your pro forma or your projections from a monthly basis, how that all is going to handle it. Like, I can say, look, here's what we give you interest only through break even, right? So your business is going to need to pay the P&I until, you have the operating deficit, the interest reserves. We can figure out interest reserves pretty quick. All right, it's going to take you a year. We'll give you a year of IO on construction. It's going to take you a year to fill up. We'll give you a year of IO of interest, interest only payments post construction. The operating deficit is the one that's a little bit more complicated, right? Because we're gonna see, all right, how much time is it going to take you to stop losing money, right, on top of your debt service, so those are the three buckets. So the closer we can get to that, the more meaningful your term sheet's going to be. But yeah, it's an art, not a science, right?
Yeah.
We're going to buffer it. But we like to know, hey, when do we really think we're really going to fill this thing up or get to an 85 to 90% occupancy, depending on your bed count.
Got it. Okay, great. Thank you.
Next question.
And I would say REL does a good job with the financial suite and all that. We will dip. I did have this comment and a question on it. We will kind of try to get your net operating margin around 30-ish%. That's one thing to think about. That's the sort of the baseline. Now, if you're doing something and you're feeling pretty good about controlling your labor, controlling your expenses, we can get a little cute with it, but just sort of being conservative, we want to get there. And then if we're thinking private pay, we're doing all this, we'd like to see it at a minimum of 1.25 times debt service coverage. And again, if people aren't familiar with that yet, I'm happy to get on a call and work through that stuff with you. But those are sort of the basic parameters. The minimum for SBA is 1.15. We like to see it more 1.25. I like to see about more like 1.3.
You just answered my question, one of them. Actually,
I have a question about that. As being part of the Rolla community, so I'm looking at new construction. So as I'm putting the numbers together on the pro forma, would you, or actually I've been speaking with one of your colleagues, Dalton, and would you or would he be able to work through the pro forma with me to kind of plug in what about new construction versus information that I have, so that complete transparency, I'm putting in legit numbers as I'm working through it, because I know that's what you need and that's what I want to provide. So would that be an option as well?
Yeah, we're here to help. And Dalton's great. I work with him quite a bit. He, we have sort of these metrics that make sense for us and how we lend and how, our credit folks want to see it. And, it's not going to be a perfect, hey, box, right? I mean, you could send that to us, but if you think you can actually get to those margins and you've got a good business plan, we'll give credence to that. And we'll help you and sort of say, hey, look, this is where the margin should be, and you can kind of adjust it. We as a lender, as a bank, right, we're a publicly traded bank, we have to be a little bit cognizant on, preparing business plans, preparing things for a borrower, just because there's some lender liability
Right.
attached to that. But we'll tell you, we'll just get on a phone call and we'll say, look, this is where our portfolio has been performing. This is where our cash flow metrics are. But knowing all that, knowing that things are gonna change, and you can probably charge more than you used to. The model is a little bit more well known than it even was 4 or 5 years ago. What we generally do is we'll have your projections on one side, of a Excel slide, and then we'll have our projections on the other side. It'll be like a lender adjusted projection, which means all we're doing is we're shocking her projections and we're making comments in a narrative below that and saying, hey, maybe she's a little bit aggressive on what she thinks she can charge for, you know, whatever expense it is. But here's her explanation, and here's why we could probably get okay with that and maybe get a little bit more comfortable, you know, putting more weight on those numbers. And so we go through that line by line. But yeah, I would just say, look, we got to work through it. Dalton's great about sitting there and going through every little line item on that end, being kind of the analyst of everything, running through those things. But you know, it's something that we're trying to get to help you get approved, but it's not steadfast, and it's not the same for every deal. That's the best answer I can.
Right. Okay, thank you.
Yeah.
I have one more question since somebody's asking a question.
Yeah.
So my background is in business management and operations, but I don't have a medical background or, you know, assisted living background. So I do have my administrator's license for New Jersey, and I have the RALA specialist designation and things like that. How does that play into the owner operator? Do I need to have, I mean, of course I have to have a nurse on staff and things like that, but does that play into, you know, being able to get approved for a loan by not having that specific, you know, experience in the RAL industry, but I have business experience and operations experience?
The answer is no. I think that having a business background, business acumen, taking the time to join groups like this, do the raw thing, get involved, be around this. I mean, this is great to kind of note as we're looking at the deal, you know. And no, we have folks of all backgrounds that come into the sector and perform really well, right? You know, in a way, having the business acumen and combining that, or hiring the folks that have the caregiving or clinical background, seems to be the kind of the magic sauce. But no, it's not going to preclude you from getting a loan. As long as we feel comfortable with you as an individual, you know, your preparation, your plan, you know, that is fine. Like it's, you know, it's more of what is this, does this thing make sense? We know the industry's got a lot of demand. We know we've had a lot of success lending in it. Are you the right person to do it, no matter what background? That's really all we're worried about. So no, it doesn't preclude you from getting a loan if you have no senior housing operational experience. And then what helps is you're actually taking the time to learn, listen to other people, be involved in these groups. It's always better than not having that and not taking the time to do the homework and listen to others that have been successful in their endeavors.
Thank you.
Yep.
More questions?
Yeah, hey, Mackey, this is Thomas. Very good presentation.
Thank you.
I wanted to ask of you on the corporate credit, right? Credit scoring. What is it that you guys use? I had done some research and I thought that Dun & Brad was the credit scoring that you use for the company. Can you talk a little bit about the company credit score?
Right. So there are a couple of things. So when on the front end, you know, we're going to look at personal credit for the guarantors, 20% or more. Then there are going to be a variety of other CBI credit pools. There's the CAVers, which means you're looking to see if, you know, you or any business you own defaulted on government debt. That's the most important one. Some of the others, I think there's two others we use right now on the CBI. They've changed over the years, but those are all going to be kind of pulled in underwriting. It's very rare that we've had business credit scores that come back where there have been major issues. A lot of times they're just disregarded entities that don't have a score. But I am, I don't know exactly, honestly, which ones we're using right now as far as the business credit. But I know that we're using all three, TransUnion, FICO, Experian, all that for the personal credit. Have you had issue, if you don't mind, if you're aware of any sort of issue on that, I'm happy to go to our folks and send you an email, but I've not run into any issues over the past, gosh, 8 or 9 years on business credit issues other than cavers, which kind of kill a deal, honestly.
Yeah. Yeah, I had been working super hard on Dun and Brad to get that done. Personal credit, it's very good,
Yeah.
but I had applied just to through SBA website itself, and it would give you like a recommendation. But but I probably should just come to you guys because you guys are the. But I think the
Yeah.
smaller SBAs, and they were talking like a lot about business credit, right? And I'm like, well, but yeah, so that was the problem. So I just told him to kill the deal. I mean, if you don't want to underwrite it with personal credit and 10% down, then everything else was good.
Yeah, I think so. I think I misunderstood what you were asking earlier, but yeah, they have they have like it's almost like a computer automated, honestly, probably like a more bastardized version of AI, where if you're not lining up exactly where they need to be on reporting, they would just say no, and they don't really go into the in depth on all that. So the things I was just saying are unrelated to that, but we do government reporting, business reporting, CBI, but that is not that's different than what they have on the SBA website. So I'm happy to explore that with you and jump into there. But as long as you've got good personal credit, I think you're just fine.
Yeah. Yeah. Thank you so much. I appreciate it.
Yeah. Sorry for the confusion there.
Okay, this is Sonny.
No
I have
worries.
a question.
Yep.
Okay, how do we respond to the issue of the 90-day close in a situation where one is acquiring a residential building for use as an assisted living, where
Sure.
they are used to 30, 45-day closing?
Yeah. So yeah, this is a huge thing. And number one, you have three options, right? So number one would be you get a good seller, you kind of say, look, this is what we're trying to do here. We need 90 days. I'm happy to speak to the seller, after we look at everything, be like, look, we got a good borrower. We're going to be approved in 2 weeks. We're going to set the closing date here. We're getting commercial appraisal. That works sometimes. The second option would be something like Vern has, a short-term debt. We'll continue to underwrite. Third option would be you can do maybe a residential loan at a shorter term, and see if that works for you. Those are the three things I've seen. I think having a lender like Vern, a short-term lender, or someone like him that may be able to help and knows what you're trying to do might be a better value, but it's up to you on what you want to do there. Unfortunately, we just can't get around the 90 days. We have to underwrite a commercial loan, and we have to order a commercial appraisal. We have to get all the things and all of that underwriting, which is a heavier lift than doing a residential mortgage. And so we just have to take a little bit longer, unfortunately. And sometimes sellers are amicable to that, but you have options, that are outside of that. If you really think this is the right place and you really want to get it knocked out. What I have seen though, in some cases, lately, the housing market's cooled off, to a degree. And you've had some more sellers that have been a little bit more flexible.
Okay.
I want to speak to that too, Sonny. I've done a lot of these deals. As I pointed out earlier, I've done over 80 of these deals. I've never seen one of these things go less than 3 months. The 45 days is a pipe dream. You know, if you're just buying a residential property, but if you're buying an assisted living, no way. You just cannot do, it's typically gonna be 90 to 150 days for an assisted living transaction. So you just gotta set their expectations. That's the key, and make them understand. Like Mackey said, this is a commercial loan. Just getting a commercial appraisal is gonna take a month in itself. So it just doesn't move fast.
Okay.
And we're,
Mackey, I've got a few questions for you too.
yeah, go for it.
Okay. So, my Lyman deal, I had someone call me up the other day that very interested, considering doing, SBA, but they have a $3 million loan out on an SBA loan out on a completely different type of business. It's a hotel business. So I told them I didn't know if they would be qualified to do another SBA, but you're the guy to ask.
Yeah, no, I'm glad you brought that up. So the NAICS code, which is a NAICS code, essentially is, you'll see it on your tax return or commercial business tax return or whatever. And they've allowed folks to borrow money that wouldn't have a runway or a limit if you were lending to different industries. So right here, if I'm not lending to a hotel, I'm lending to an assisted living, then I get more runway, right? So that was great. That's great that they allowed that. I have not heard any guidance on them pulling back off that, but that is something we need to check in on June 2nd, like whatever. What's today? Wednesday? So Monday, we'll see if that still stays. But yeah, you are technically able to do that. We've done that quite a bit, as you can imagine. I've had some self-storage customers where they wanted to do assisted living, vice versa. And we've been able to kind of extend the runway there, which is great. Now that all being said, does a bank want to lend someone $20 million altogether, right? So it's like, just because you can do it doesn't mean a lender is going to be like, all right, maybe we have a little bit more exposure than we want with this particular group or guarantor. So great that we can do it, but also keep in mind, lenders are going to have exposure on anything they do, whether you have an SBA loan or not an SBA. You could have a bunch of conventional loans, and they may say, "Hey, look, we're out. We can pay us back a little bit. We'll talk in a year." So yes, those things are there is ability to do that. And look, if they only have a $3 million hotel loan, they're in a good loan to value position. The assisted living deal is looking really hot. Probably good, right? I mean, we're probably good for up to 7 to 8 million, 9 million in-house, and then, or if we do SBA 504, maybe bigger, right? But again, just because the rules say we can do it doesn't mean that a bank is going to do it, just because we got to keep everything in mind of exposure, right? So that's my answer to that.
Okay, that's helpful. And of course, we're hearing a lot of questions about seller carry on these deals.
Sure.
So if they got to have 15% down, can the seller carry apply to part of that 15%?
Yeah. So it's going back to the old rule from a few years ago. You can have, so let's make it really simple using your example, right? So, look, man, this deal works at 15%. We're willing to bring, whatever. The seller can hold up to 5% of that down payment. And that can count towards your down payment. So instead of bringing your full 15% in your example, Well, you would only have to bring 10%. Now, the catch to that would be that that particular part, that seller note, that 5% of your down payment needs to be on full standby for the life of the loan, which means the seller does not get paid until the bank, whether it's Live Oak or another SBA lender, gets paid on that loan, or they refi the loan. Now, that seller note can accrue interest, but the bank, the first lender, has to be out of that note before the seller gets their money. So that is more common. You'll see that on a goodwill transaction, like a 10-year loan. Most of these are going to be 25 years. So, you know, you'll see it once in a while, but knowing that they may have to sit on that for 25 years, maybe they want to do it, maybe they think that you'll refi, who knows? But that is a way to get equity. You'll generally see them doing this, like, for example, the best example for this is outside of this industry, but it would be like a veterinarian practice, right? So, hey, I'm a senior vet, I'm getting out, I've got an associate veterinarian who they don't make any money, they don't have the money to put down, maybe their parents come in with 5, and then I'll cover 5 on full standby, and I'll just leave it to my kids or grandkids, right? On a 25-year deal. So that's kind of what you see. I've seen that mainly in those industries. Senior housing, a little bit different. Or if you're selling to a family member, right? So if you're selling to your kid, you know, that always helps, and that's an easy tax write-off and all that fun stuff. But yes, that is the rule for seller notes counting towards equity, and that's the rule that's going to be in on Monday, compared to a rule where you could count 2 years of full standby towards some equity position. But yeah, that's the new, or the old rule that's being reinstated. That's what I have pretty solid information on as of today.
Okay. That's,
A quick question on that, if I may.
Yeah.
So on if they're carrying some debt that's treated just as, you know, they're in whatever position that they're going to be in, subordinated.
Yeah, so the seller carry, whether it's, so let's just be really clear. What Vern asked about was seller carry that could be counted towards your down payment.
Right.
Now let's just talk about regular seller notes. Very common. So you can have a seller note that's 20%, 30% of the capital stack.
Got it.
You can be behind the bank, right? It has to be behind the bank.
Yep.
Bank wants to be in first position. I love seller notes. It keeps the seller honest. It keeps transition the best. Like, you know, they don't get all their money right away. You know, they're gonna have to, you know, they're not just gonna move to Florida or Hawaii or wherever they want to go and never talk to you again. You know, they're not gonna leave you on the hook with vendors you might not know about. You know, you're probably gonna be okay because you're gonna do an asset sale versus a stock sale. It's a whole nother thing.
Mhm.
But I think that having a seller note makes everyone else feel pretty good. And maybe you pay a little bit more than you want, but you always feel a little bit better, you know, having them on the hook for a little bit after the close.
Great. Okay, cool. Thanks for that clarification.
so along that lines of what you just said, Mackey, that seller note can now be due sooner than the primary if it's not part of that.
Correct. Yeah. And I'm sorry I wasn't clear about that. Yeah. So you can have a seller note that gets paid right, starts getting paid right at close, like just like the first loan, right? You just have 2 loans. You're paying the bank and you're paying the seller. You can have it on standby. You can be very creative on how you want to structure the seller note between you and the seller. It just has to make sense for cash flow for us, right? So we're going to review the seller note, make sure that you're not paying this, you know, you're not hitting your business hard with debt service from a seller and making it difficult for you. So, but yes, they can start getting paid at once. It can be on standby. It can be on standby for 1 year, 2 years, 5 years. There can be a balloon on it. So a lot of different ways to structure it, but yeah, the only thing that matters is if it's counting towards your down payment, that would be on full standby, but the rest of them, you don't. And so what a lot of times you'll see is, hey, seller, I would really like to negotiate 5% of your stuff being on full standby, but I'll also do maybe 10 or 15%, where you start getting paid right away. Does that work? Because I'm just trying to make it work for for my leverage. And so those are the discussions, those are the negotiations that you would be having. And we're happy to jump in and run those numbers and help with anyone as they negotiate. It's pretty simple to do on our end.
Okay, that's good info. Yeah, that's really helpful.
Trying to think what else. I mean, we've done quite a bit. I think we're about 150 million year to date in closed loans. And we're, however many, I think that's 68 transactions. And a lot of it's this. So in our little group. So we're seeing a lot of movement in the market. We've seen a lot of like maybe price adjustments. It's just things are seeming to where buyers and sellers are kind of coming together a little bit more than they have over the past few 5 years and the kind of the turmoil years. I will say this: the only thing what I didn't mention, and I know everyone's maybe has more questions or it's getting late, but I want to mention appraisals and appraised values. Live Oak, if we have the subject property and that appraised value comes back to cover our loan, we're not going to go after additional collateral. So you'll see a lot of lenders that'll say, hey, look, even though that, our loan's secured, we still want to take liens on your other real estate, maybe secondary, third, tertiary liens, whatever that is. We're going to do the best we can not to do that. We're not really getting much value out of a second lien position on your rental house, right? But I want to make sure everyone's aware of that, because those are the rules for the SBA. If you get a bad appraisal or an appraisal that's a little bit low, and you have equity in your real estate, the rules dictate that we have to take a lien. And that's never fun. Don't want to lock up anything. We want to kind of keep this as its own little deal. But just know that. It's very common, like if you just bought the business operations, which is like a blue sky deal. So for example, if, hey, look, I'd love to buy just the business, do a 10-year loan, I don't have the real estate involved, then you're really going to have to, that's probably where you're going to have to kind of lean up everything that's available. The only kicker is if you don't have equity in your real estate and maybe you don't even own real estate, the program still allows you to loan. And that protects sort of the small business owner that maybe doesn't have the resources or equity or even owns real estate. But it is unfair to people that did work hard to pay down their loans and buy properties and do all those things. I don't like that part of the program, just because that would kill my profile. But I just want everyone to be aware of that as they manage it. If you work with a different lender and they're trying to kind of, if you get a really good real estate appraisal, push back on that or come over to our way and see what we can do for
you. That's interesting.
Yeah. So if you don't have real estate and you're shorted on the appraisal, you have a couple options, right? You pay more into the deal, the loan amount goes lower, so where it's secured. That's number one. Or they get like a life insurance policy, or they're gonna get like if you have partners, they'll get like that or a succession plan, right? So if something happens to you, then the business would go to your partner, or however that works, and you would want to get your estate attorney or somebody involved there probably. But there are those rules with SBA that run into that, and I've been noticing appraisals coming in lower just as things have cooled off a bit in sort of the real estate market, whether that's residential, commercial, or whatever. But I just want people to be aware of that as they kind of navigate navigate how things are happening, and make sure whoever you work with has senior housing specific appraisers. And as Vern knows, we've known all of them doing the NIC conferences, and everyone kind of knows everybody. Realize the bank can't have any direct contact with the appraiser, and that's a Dodd-Frank thing since the Great Recession. But we try to pick people that are going to be picked off a list. We just can't contact them directly and argue for the value if it comes in lower. But I've noticed things coming in a little bit lower the past 6 months.
I have a question. So
Yeah.
I'm new to the RAL space and I've never taken out SBA loans for anything. The only loan I know about is to purchase, primary residence. So last month I was working on a deal which was an existing assisted living facility. And it was a really good deal that they had received multiple offers. So I ended up not getting it. The seller accepted somebody else's offer. So my question is there anything, just like when you go shop for a home, you know how you get a pre-qualification or a pre-approval letter, so that you have more purchasing power over others? Is there something similar to that when looking for and acquiring an existing assisted living facility? Is that the term sheet?
Yeah, so there's a pre-approval, a pre-qualification, and then there's a term sheet.
Okay.
And really what the differences between a pre-approval or a pre-qualification and a term sheet is basically what you've given the lender the ability to review, right? So if you are like, hey, the seller won't share me their financials or anything until they know that I'm pre-qualified or pre-approved from a lender, right? That would be that the pre-qualification document. So basically what I would see and what I generally ask for, the most basic thing would be just a personal financial statement, which I can send a form for you for that. And I'd look at that, and I say, hey, look, you would qualify for the program. Does that mean you're going to get approved? Not necessarily. Moving forward, look, if you came to me and you said, hey, I got last 3 years of tax returns on the seller, I got this, I got all this stuff, where would you be? Then it's sort of a more comprehensive document would be the term sheet, or what we call the proposal letter. Say, look, I looked at your personal financial statement, I looked at your tax returns, I looked at the seller's tax returns. This is a deal I think we can do. And that would be the next level. And then the final level after underwriting and all that would be a commitment letter. And what that is that's sort of the ringer, right? That's a legally binding commitment to fund the loan, right? And you would show that to the seller and be like, look, I'm approved. Let's set the close date. So it's just a matter, like a lot of sellers will sit there and be like, I don't want everybody coming through here, seeing all my financials, like let's just get a little bit more of a barrier. And so they may sometimes ask, all right, let's just make sure that they're pre-qualified. Some lenders looked at them, and then that maybe they would then share their financials. Does that make sense?
Yeah. So
Great.
is the term sheet something that I get before getting the property before submitting an LOI? Is that something I can submit with the LOI or after the fact?
I've seen it every way you can ever imagine, right? Like I've put terms out on deals that were under LOI. I've put terms out on deals that were under contract. I've given really high level term sheets on deals that, maybe you had an offering memorandum. So it's really fluid. It's sort of like playing that game. It's playing the game of, all right, what does the seller really want? How
Mm-hmm.
serious are they? How many other buyers are interested? It's there are a million ways to skin a cat on that. But at the end of the day, I want last year's the seller's tax returns, their real estate holding company, their operating company, payer source, rent roll. I want to know what they're doing. And then I can feel really confident about what I'm issuing.
Okay, gotcha.
So,
Okay, that makes sense. Thank you.
yeah.
Okay, anything else? We are getting a little late.
Yeah.
Hey, Vern, actually, I have one more question.
Okay,
So how would you guys look at, so currently we have two properties in our personal names as far as credit wise. Would you take, it's solely paid out of an LLC that owns the real estate, or that the real estate is under. So would you guys look at that, see like 12 months that is actually paid out of that account and not our personal account, to show that if that LLC is responsible?
So it's just going to come down to with SBA, it's going to come down to like what a warm body is, right? So if you say you own that LLC, you own that 50/50 with your wife or whatever, it's still going to be something that we could go after. That makes sense.
Yeah, but I guess what I'm trying to figure out is like from a.
Okay, so if you put it in a trust, I'm giving you the answer to this question. If you put this thing into a trust and it had different ownership, for example, so like say it's like you and your partner in the business, you guys own it 50/50, and you guys are going into the business 50/50, we would go after it. But if you had a rental property or a multifamily property that was owned by other folks and they had interest in it, then that would be very difficult to go after, and we probably, a lender wouldn't go after it. Well, my thing is, private banks really not interested in doing that unless it falls within the SBA rules. And I think what you're getting at is, as long as it's owned by different ownership, then we wouldn't go after it. Does that make sense?
No, I'm sorry. Yeah, no, that, I guess I'm not stating my question correctly. What I'm saying is, let's say, using easy numbers, the mortgages on those two properties are $4,000 each. Would that count against our debt to income ratio if it's 100% paid out of a different house? Like it's because
Yeah.
the way we structure ours is the business is one.
Right.
Another.
Got it. I got you. I didn't hear you earlier. So if you can mute, I can answer it. So this is all about debt to income ratio. So that's just sort of, we look at a global cash flow, right? So all of your income and your liabilities, like what you're making and what you pay in your debt, all that kind of stuff. We'll do a calculation on it. But as long as you have outside income to cover those and you're doing well keeping those payments, then there should be no issue. It's more of an issue if you were late on those. Why were you late on those? And the great thing about this is there's no set debt to income ratio. We have a set debt service coverage ratio, but not really any DTI ratio that would matter, right? So as long as, and that's different for everybody, right? So as long as you're able to cover, based on your personal credit report, all the liabilities associated with your personal stuff, and then also on your business, if you had other businesses, which maybe you do, maybe you don't, as long as those things are kind of covered outside the deal, that makes things a lot easier, right? Because that's not going to affect you negatively. So it's not like a set DTI like you would have on a residential mortgage. It's sort of a little bit more flexible with it, and we can be reasonable with that. But yeah, as long as you're covering everything outside the deal, especially if you're doing a startup, you're fine.
Cool, great, thanks, appreciate your time.
Yeah, thank you.
okay, maybe one more question. No? Well, Mackey, that was really informative and very helpful.
I appreciate it. And if anyone has questions, shoot me an email. I'm happy to hop on the phone. I'm sure they'll come up, but I appreciate the time, Vern.
You bet. Just a
Hey,
reminder.
Mackey. Hey, this is Thomas. I'll reach out to you. I've got two small deals for you. 800,000 each, so 1.6. But it's two separate deals. But I'll reach out to you though.
I
Thank you.
appreciate that. Looking forward to it.
All right.
Just a reminder on that meeting chat, if you click on those three buttons, three dots at the top right, you can save that chat. So you'll have all of Mackey's information there and the information for everybody that contributed to the chat tonight. We do finish up with the haves and wants. If anybody has something or wants something from the group, now is your opportunity to express it. So does anybody have any haves or wants they want to put out to the group? Going once. Okay, well, thank you everybody for staying late. I know for some of you it's very late, and Mackey, where are you at?
Vern, I have a question real quick for you.
Oh, sure.
Do you have like a calendar, something to schedule a call with you? Or just give a call tomorrow, or how do you usually structure that?
Just shoot me an email to the email on there, vern@assistedliving.com, and we can set up a time.
Okay, perfect. Thank you.
You're welcome.
Yeah, Vern, I'm on East Coast time, so it's about 11 p.m. But it's
Well,
it's all right.
thank you very much for staying up late for us.
No problem.
We really
Happy to.
appreciate it.
Y'all have a good one.
Okay, thank you, everybody. Thanks for joining us.